Hi, my name is Thomas Pomasa. My partner is Holden McGinnis. We have done a case analysis of Walgreens and CVS Caremark. Who are the shareholders? Walgreens have 858 million shares outstanding currently. Institutions own about 65% of those. Mutual funds owns about 1, and 1% are owned by inside employees. Some of the top institutions that do own those shares include Vanguard, State Street, BlackRock, MFS Investment, Wellington, and Orbis. CVS currently has 1.27 billion outstanding shares. Of the 1.27, 85% are owned by institutions, 2% are owned by mutual funds, and less than 0.5% are owned by inside employees. Of the top 10 institutions, some of the big names include Davis Selected Advisors, Vanguard Group, State Street Global Advisors, Fidelity, and BlackRock. Do they care about cost of capital structure? We believe they do. We believe cost of capital structure affects the performance of the company. We believe capital structure affects tax saving, price per share, credit risk, investment decisions. The advantages of debt are tax savings and no change in amount of outstanding shares. Disadvantages of debt: higher bankruptcy costs, loss of flexibility, and agency costs. Walgreens currently has an after-tax cost of debt of 1.6%. CVS Caremark Corporation currently has an after-tax cost of debt of 2.8 to 75%. Walgreens has less cost of debt financing when compared to CVS Caremark. Walgreens is preferred in this area. Walgreens' cost of equity financing is currently at 8.45%. They are about 8.53% away from their optimal level of 16.98%. CVS cost of equity financing is currently at 6.36%. They are about 1.63% away from their optimal range of 7.99%. Could we lower cost of capital by changing our capital structure? Both companies could increase their debt ratio to reduce the cost of capital. Walgreens could finance more debt by 63% to reach their optimal debt ratio of 70%. This will result in better tax savings and increasing company value by 9.6%. CVS could finance more debt by 27% to reach their optimal debt ratio of 50%. This will also increase their tax saving and their company value by 6.9%. How would financial restructuring affect the value of our company? For Walgreens, their value would increase by $9.6 million if they were to obtain more debt up to their optimal debt ratio. For CVS, their value will increase by 6.9 if they reach their optimal debt ratio. Would more debt create unnecessary risk? We believe more debt would create unnecessary risk for both Walgreens and CVS Caremark Corporation. Walgreens is preferred due to their low amount of debt in this area. What does the competition do? Walgreens currently have more cash and current assets available when compared to their competition CVS and Rite Aid. They also carry less long-term debt. Is our stock fairly valued? We decided to use the dividend valuation model to find out the fair value of the stocks. For Walgreens, we found that the current stock of $35.70 is currently undervalued by about $100. Using the same dividend valuation model for a fair value of stock, we found that CVS is currently overpriced by about $12.92. It comes down to the last question: which company to invest in? CVS or Walgreens? After doing our analysis, we came to the conclusion to pick Walgreens. Walgreens has a lower debt ratio, their shares are currently cheaper at the moment, and it is also undervalued.